everyone, and welcome to today's video. In this video, we will be discussing how to identify imbalance in the markets with order flow trading. We're going to go through a number of different things. We'll be looking at the depth of market, some footprint charts, and we're going to start out by defining what is market imbalance. So, market imbalance refers to a situation in financial markets where there is an unequal distribution of buy and sell orders for a particular security, asset, or financial instrument. It occurs when there is an excess of either buy or sell orders, creating a temporary mismatch in supply and demand. Market imbalances can occur due to various factors, including the release of significant news, unexpected events, changes in market sentiment, or trading strategies employed by market participants. Imbalances can result in price volatility and may impact the overall market conditions. When there is a market imbalance, it generally indicates an excess of buying or selling pressure, which can influence the price of the asset. For example, if there is a higher number of buy orders compared to sell orders, it can drive the price of the asset higher due to increased demand. Conversely, if there are more sell orders than buy orders, it can lead to downward pressure on the price. Market participants, such as traders and investors, closely monitor market imbalances as they can provide insights into short-term price movements and potential trading opportunities. Some trading strategies are specifically designed to take advantage of market imbalances by capitalizing on price discrepancies caused by the temporary mismatch in supply and demand. So, I know that's a long definition, but I think it's important to understand what exactly is defined by a market imbalance. So now we're going to go into the depth of market. And to understand this, if you're not familiar with the depth of market or trading with a ticket like this up on your screen, we're going to break it down. Before we go into breaking down this depth of market and the price ladder, let's discuss what order flow is. Order flow is the mechanism that moves prices up and down. It is the balance or imbalance of buyers and sellers. It's the onslaught of market sell orders that overwhelm the buy limit orders, or the market buys that overpower the limit order sellers. So here on the depth of market, there's three main columns. We have the bids, the price, and the ask. Currently we're looking at the S&P Mini. On the left here, we see the number of buyers willing to purchase the S&P Mini at a specified price. And on the left here, we have the number of sell orders that people are willing to sell at a specified price. So what I'm going to do is pause this. Okay, so now we can take a frozen view of the depth of market. So at this given time, as you can see, it moves quite quickly. But at this given time, at this screenshot, there were 278 orders willing to be bought at $42.99. There were 134 orders willing to be sold at $42.99 and a quarter. This column over here, the last traded, this is the last amount of contracts that traded at this price. So in this specific example, there were 39 contracts purchased at $42.99 and a quarter. The reason this is important is because of two things. On this ticket, we have two types of data, level 1 and level 2. Level 2 data is the number of limit orders at each price willing to be bought or sold at the market. This data point right here, the 39, that's a market order. So it could have come in multiple 1 lots or a 10 and a 5 or a full 39. But this was a market order being bought at $42.99 and a quarter. So when we talk about indicators and order flow, indicators are lagging, order flow is real time. And this is why markets move. It's the imbalance of buyers and sellers that either push price up or down. So in this case, at $42.99 and a quarter, if people continued to purchase that price, let's say a 500 lot came in, and there were still 134 offers left here, we would have, can't do quick math, but Out of the 500, 134 would be filled because that's what's available to be sold at 99.25. And then the bid would come up here to 366. So we would have 366, and then this would just be blank because now the next best price to be sold is 99.50. It would have wiped out everything here. So it would have wiped out everything there. And then when new market orders come in, it would be trading on this price, 99.5, and this price for the sell orders at 99.25. So now that we have a basic understanding of how depth of market works and the price ladder, let's take this a step further. So a lot of traders, they can either just trade with a bar chart. Myself, I prefer to have this price ladder up to see how the market or how the orders are coming into the market, what's happening with the bids and the offers. Are they getting refilled? Are they moving away from price? So in a down market, you can typically see algos and people start pulling their bids if they really don't want that price filled, which creates a further imbalance if there's already selling demand and selling pressure. So I think it's important to have this up just to see the raw data coming into the market. It's extremely difficult to process this as quickly as what it's happening, and then you'll see certain things like that price just flipped. I might have a question of, okay, how many contracts traded or have traded at 96 so far? I just saw sellers hit that bid, and then I saw it flip, which means that bids reloaded that price. So that might be a hypothesis of, are there more bids going to be coming in here, or is there too much selling pressure and those prices are gone? The way that we can do that and take a step further into the detail of that is a footprint chart. I'm a big fan of footprint charts. It's really easy to incorporate within Optimus Flow. We're going to come down here. If you don't have this bar, I think you need to come. So on any chart, you can implement this. You have to come up here to this little icon, and if you hover over it, it gave me a pop-up, but it's essentially show volume analysis toolbar, which is this down here. So we're going to click on that, and then for the footprint, I set up a cluster chart, and my type is double. Data type 1 is sell volume, data type 2 is buy volume, and then I color by delta, which I will explain shortly. So in this instance, we saw the bid flip here at 96 with some significant volume, and it's after market close, so typically it's not going to be trading much, and there's higher volume in each price. But one of the questions that came up was, okay, how many contracts have traded at 96, and how am I going to use that information? So if we come over here to the footprint chart, we can see 96 right here. And again, this was after market close, so yes, a lot of volume, but we can actually see the exact amount of contracts that were traded at that price. So we saw some sellers come here at 96. That means they're hitting the bid, which translates into sell market orders are being matched at the best possible bid. So when those orders happen and we see an imbalance of a lot of sellers coming in, and we make a hypothesis of there might be more sellers and there's not enough bids to absorb that demand in selling at that particular price, then we see what happened here and price moved down because there weren't enough bids at 96 to hold that price. There was more sellers than buyers. But in the footprint chart, you can come in and take a look exactly how many contracts traded. So when we go into one of these bars, and this is a 1 minute chart on my footprint, this is saying, let's take this bar right here, for example. The high of this bar was 96.75, low was 95.25. So when price came up to 96.75, we don't know looking back, we don't know how many contracts were offered here at 96.75. In real time, we can see, okay, there's 172 contracts offered at 5/4, 145 or 151 bid at 95. So we can get a rough idea of how many contracts would need to be sold at this price to move price down another level. But in this, on the historical data, we can only see how many contracts traded at that price. So at this high, there were only 7 contracts purchased at 96.75. On the low of this bar, there were 70 contracts sold into the bid at 55.25. And when you have a number like this on the right side and it's not zeroed out like it is here, that means this price flipped at one point. Just like we saw that price flip earlier at 96, that means that temporarily there were more sellers, let's say here at 95.50. Well, let's use this, 95/4. They offered it, so there might have been, well, there was probably 134 offered at 95/4, excuse me, and immediately buyers took that price up, which means there were more buyers than sellers at 95/4, which we're seeing here. There's more buyers than sellers, and there was absolutely no interest in 95 when that price flipped, meaning that there were no market orders coming into the market at the time this price flipped at 95/4. So I know that's in depth, and we'll continue to get into it, but the footprint chart can tell you and show you exactly how many contracts were traded at that price. So next we'll take a look at how to look at imbalance and how to identify that in the footprint chart. So now we'll take a look at a few instances this week that I think were good examples of how to read order flow, put it on your footprint chart, and make an effort to make hypotheses about what price should do or is doing at certain levels based on just basic technical analysis. So on June 5th, which was Monday this week, 15-minute. So prior to this week, traded up here to about 42, 43, came down, broke market structure and started trading up, and then made a new relative high, came up and broke that high, and then retested support and broke through it. So when we're talking about order flow, let's take these 2 points here. We had 1 touch, it formed support, 2 touch, 3 touch, 4 touch, broke through, and then retested. So based on the idea and the understanding that the only reason markets move is because of an imbalance between buyers and sellers, we can start observing and asking ourselves, if price comes down to a certain level and it looks like it's going to hold, what would that scenario look like in terms of how many buyers there are, how many sellers are getting interested in a potential breakout, or are they expecting this to hold themselves and they're just taking maybe a small risk to see if it goes through. But once you start understanding that, you can create scenarios and kind of develop what it would look like, what you would want to see it look like if the support was going to hold, what it would look like, or what you would want it to look like if it was going to break, and really using the depth of market and the footprint chart to identify areas of interest and points of interest for potential trades. So this is a 5-minute. I am going to break it down here into the 1 minute. So it touched here at 11:12 right here, and this was the very end of this. Remember, it formed here, touched it, came down here, and then we just had lower highs, lower lows, and just a lot of selling pressure that pushed it through. So this is the area that we're looking at. So on the last tail end of this, it touched it, broke through it, and then finally broke down. So in the footprint chart, we can see that yes, price came down. As price came down, we can start to see some larger numbers here indicating that buyers through limit orders were willing to buy this area of support with the anticipation that it will hold. Price came down, we saw a lot of volume and a lot of aggressive selling. And obviously that happens in every situation. There's support. Some people think it's going to hold. Some people think that's going to break. And then they make a trade based on their assumption or their hypothesis. And they're either right or they're wrong. So it's difficult to say, oh, here's an imbalance and this is what it means. Really what we're doing is just observing that there is an imbalance and then observing what the market does based on that and trying to make real-time decisions based on our overall thesis of what's happening in the market. So we came down here, saw a lot of volume. This negative delta, 1183, means that there were 1183 more orders sold at the bid than there were bought at the offer, meaning that there were more market sellers participating in this than there were market buyers. So we saw that delta go pretty big negative, and then on the next bar we saw a positive delta, meaning that there were more market buyers than there were market sellers. And we also saw volume decrease here. So interest in selling, same amount of interest in buying, and then we saw less volume and came back up a little bit and then just kind of died off and then retraced about 21 ticks from that level. So then when price came down, so the volume here was 57.95, came down again, another big spike in volume, another big spike in negative delta, meaning that there was a lot of interest in market selling here. But at the same time, there were a large number of bids holding that price and absorbing that selling pressure. We got a small pop, and then this is when the breakdown occurred. So same thing here as it was here. There were a lot of bids, and then when price came down, there were a significant number of bids holding the market up temporarily here. 3,600, 46, 54, almost roughly 6,000 contracts on the bid, absorbing that selling pressure for as long as it could. And then because there was an imbalance and there were more sellers in the market than there were buyers, once it got through all of those bids, it started to break down. And so on this bar, remember we went over the delta, negative 1,600. On this bar, there was 3,900 more market sellers than there were market buyers. Again, big spike in volume. Price continued to come down, still negative delta, and then either people started covering their positions or new speculative longs in this area. There were more market buyers for a few bars, and then another round of selling, another round of selling. Now I want to point out some key differences between this support area and then the next part we're going to go over, which is a retest of the breakdown of the support area. So we saw a lot of bids here. It was a well-established range, well-established support area. There were definitely people buying here. And when we think about logic and what's a high probability trade, the market has held this support higher high. Yeah, broke market structure here a little bit, but that could be viewed as a liquidity grab because it came back, made a new high, and came back down to test this support. And that's where we saw the bids, some interested sellers, but there was a significant amount of bids here, and we identified it here as well. So now when the market comes back to retest this level using order flow, we can identify if we were short and we thought that this retest was going to hold, what would we want to see in terms of order flow if we felt that the majority of people were also going to take that position and hold price at the retest level and continue to drive it down. I certainly wouldn't want to see this amount of volume on the bid side. In retrospect, it worked out because there was a lot of people that took buys here, speculative, and then when price continued to break down, they had to puke their position and they turned into sellers and drove the price down further. So that was a potential short if you thought it was going to break out. But the people who purchased here, and it's not just all day traders, speculative, short-term trading. There's traders that are taking longer positions. And what they will do is wait for price to retrace to make an effort to get out of their position with the least amount of loss possible. So identifying this position, we saw it break down, and if we were short and we wanted to get in on a potential continuation of this, we might wait for the retest. So when we wait for the retest, what would we want to see in terms of buying and selling and order flow? Well, I would want to see that there were speculative shorts here, so there were offers being filled with market buys. I would want to see price quickly move away from this, and I would want to see buyers trying to get out of their long position back here at the best price possible. And it consolidated here for a little bit, but the thing that we have here is that there wasn't a ton of volume in this consolidation area, and it was very short. It was 7 minutes. And what we saw is when price got up to this level, it immediately retraced and tested the lower part of this range, the lows that they previously just made. So my point here is that the market will look different in different scenarios with order flow, and it's never a clear indication of what's going to happen per se. However, you can make a hypothesis about what it should look like, what it should feel like if you were wanting to get short here. How would you want to see the market react when it got here? And I think that we could probably assume that when price got here, bidders were the longs that are trying to get out of their short position, they were exiting their position, so they might have been bidding, or I'm sorry, they might have been offering, but then when price didn't stay up here for too long, they were probably hitting the bid and selling their orders or selling their positions with market orders, which again drove price down. And we can see that here in the negative delta, there was an imbalance and so on. That is all I have for you today on imbalance and order flow trading. I hope you enjoyed it. If you have questions, please visit us at optimusfutures.com. Thank you.